Hey guys, it's Sam with Ready, Set, Go. Welcome to the video. Wanted to do a quick little introduction to dividend growth investing. As many of you guys probably know, my blog is primarily focused on dividend growth investing, affiliate marketing, building websites, and different ways to kind of develop these passive income streams so that, if you put in the hard work right now, down the road, you don't really need to work for every dollar that you earn. Uh, Having said that, there's many ways to develop these passive income streams. Primarily, the one that I focus on as a tech guy is the internet. I've worked on various web applications, pieces of software, and websites that have developed passive income and were built with the main goal of achieving passive income. However, there are other aspects of life where you can have this passive income mentality still be able to succeed. And one of those is investing. When you typically think about investing, you think about get into a stock, get out, make my 200%, I've doubled my money, and that's it. Now I just need to do that over and over and over and over. Well, that's not the case. There is a way to invest your money, your retirement money, with a more long-term strategy that one day you could be earning $500, $600, $1,000, $2,000 a month from your dividend portfolio. And therein lies the key. It's the dividends. The dividends will be paying you out on a monthly basis and giving you this passive income stream that you can live off of and not have to work for. So let's take a quick look at the numbers and dive right in here. So let's say you have a portfolio of there's varying sizes in the left-hand column. This is based on a 7% dividend yield annual. Remember that. So if you were to have a 7% yield on a portfolio of $10,000, that would come out to $700 a year. Well, if you had a portfolio of $100,000, you could technically earn $7,000 a year if your average dividend yield across your portfolio came out to be 7%. Now, down the road, over the course of, let's say, you grow your portfolio to be $200,000, well, you'd be earning $14,000 a year. And that's a pretty significant amount of money. That is maybe not enough to live off of, but that is not a small chunk of change. And the beauty of that is that if you actually space out your dividend yields throughout the course of the year, you could actually split that $14,000 up, where you're essentially earning a little bit over $1,000 every month from a select group of dividend companies that are announcing or had to have their ex-dividend date that month. And you'll see that money being deposited into your bank account, and you could technically withdraw that if it's not in a tax sheltered account and be able to spend that freely. So that's the beauty of dividends. They pay out 4 times a year, and that type of cash flow, it doesn't even matter about the capital appreciation at that time. If you're investing in companies like McDonald's, Coca-Cola, Johnson & Johnson, all these companies have 3 to 4% dividend yields, and they are consistent. They're dividend champions. They've been paying dividends for the last 50 years, and as long as they remain profitable, they're going to continue paying dividends. So when you go 5, 10, 15 years down the road, it doesn't even matter if the stock price is appreciated, because at the end of the day, these companies are still going to pay you 4 times a year. And by accumulating enough of these companies, you'll be able to make this type of money every single year. Which is amazing, right? Well, how does that happen? I don't have $500,000 to invest in dividends. I don't have $1 million. I'd love to make $70K, but how do I get to $1 million first? That's the question that kind of pops up in your head right off the bat. Well, you got to put in the time. So the main tenet of dividend growth investing is always reinvest your dividends. No matter what, until you need to live off monthly dividend income, you always put the dividends you get back into buying more shares of stock. And what this does is, So what this does is it grows your portfolio. You're gaining more shares that'll eventually pay out more dividends in the future. So let's say today I earned $10 and Coca-Cola is trading for $40 a share. Well, I could, if I reinvest that dividend, I'll be getting another 0.25 shares of Coca-Cola. Well, if that's 1/4 of a share, right? So out of that $10, I'll be making that reinvestment is going to be paying me $2.50 a quarter. So what that does, if you're thinking larger scales, you're going to be slowly reinvesting. So your total shares of Coca-Cola might go from 40 one year to 42 to 44 to 47 to 50 to 53. And then 10, 15 years down the road, you're not only getting dividends on the initial 40 you bought, you're getting dividends on the 60 to 70 shares of Coca-Cola that you now own because you've been reinvesting in their company. So let's take a look at an example. Here's a nice little chart. If you had $1 back in 1930 and you were to track the S&P 500, if you didn't reinvest your dividends just based on pure growth of the S&P, you'd be sitting at that $1 would now be $49. So with that same logic, if you started with $1 in 1930, but you were to reinvest all your gains, every single dividend you earned, you'd be sitting at $1,259. And right off the bat, you can see that you have made a considerable improvement upon that. 49 compared to 1259 is no joke. That is some serious growth. That is a completely different league, and that's how you reach that $1 million. If you are to spend the next 15 years reinvesting your dividends, living a lifestyle that allows you to continually put in a new influx of capital and grow that portfolio, dividend investing in the long run will outpace many other forms of investing. I promise you. Don't do the penny stock thing. Don't go and make a buck here and then lose $10 there. Dividend stocks are solid companies. They have great earnings, and they will continue to pay you out over the long run. Coca-Cola is not going to go anywhere. McDonald's is not going to go anywhere. Procter & Gamble is not going to go anywhere. These companies are established. They have economies of scale. They have the infrastructure to always hold a market share. So not only is it safe, but these companies are paying you every quarter. And as long as you give them the money back for them to grow, they'll help you grow down the road. So, another question I often get is, I don't have that much time. This graph is starting in 1930. That's 80 years ago. I don't plan on retiring in 80 years. I need to retire in 30 years or 20 years. Come on, that doesn't make any sense for me. Well, let's take a look at it starting in 1987. That's not that long ago, to be honest. If you were to start right now, even if you're 40 years old, this is a prime example of where you have 30 years. If you started today and you had to touch your dividends in 20 years, that's still enough time to see some substantial growth. Don't think of it as this is 40, 50 years down the road. I should have started this when I was 20. Even if you have only 10 years, but you are able to allocate that capital to this, it's still going to pay you back dividends in the future. So let's take a look at it from 1987. If you had $100 in December of 1987, in 2012, it would be worth $577. Again, this is an index tracking fund. You'd be in the S&P 500. It'd be worth $577. However, if you were to reinvest all of your dividends over the course of that time frame, you would have almost doubled your capital appreciation. That would be sitting at about $1,000 and about $1,000, and that is a huge return, guys. That difference is outstanding. When you look at it, being able to put that money back it might be a temporary sacrifice. You don't get to touch that money now, but that dollar you put away now will be earning you $5 in the future. And if you continue to do that over the long run with all those dividends you're getting, it grows to a significant amount. I mean, this is the power of compounding growth. It is beautiful. And this is probably the most natural way for you to incorporate compounding growth into your portfolio. When you're trading on a weekly or monthly basis, there's no compounding growth there. You need to be able to time a stock. You need to be able to judge the market down to a level that not many average traders can do. Even the best of them actually aren't able to do it consistently. So implementing this strategy is by far one of the best things you can do for long-term growth for your portfolio. I highly advocate dividend growth investing, and I personally do it myself. If you go to my site at www.readysetgo.com, my portfolio is available for you to take a look at, and I document all my buys, all my sales, exactly my thought process behind every purchase, and exactly what I'm doing to prepare for the future. I'm looking at this as a 20-year plan rather than I need to make a quick dollar. So I highly urge that you guys take this same long-term perspective. Many of the great investors of our day, Warren Buffett, Ken Fisher, they all have this long-term value investing perspective that truly does reap benefits in the long run. And I highly recommend you guys do a little bit more research for yourself. Leave me a comment. Let me know what you guys think. Love to have a discussion. And again, if you can't find me on YouTube, you can always find me at www.readysetgo.com. Again, I'll be releasing more videos like this. If you enjoyed this one, please subscribe, give it a like. Every little thing helps, and hope to be doing this for you guys again in the future soon. Great. Well, thank you guys for watching. Again, if you have any questions, reach out. I would be happy to answer them. Word. Peace.